Yeah, I do. It could be June or July, but I think it's going to be June. There's a lot of pressure on the Fed to try to so-called normalize rates, to get rates up to a level that if anything problematic starts to crop up for the U.S. economy, if rates are higher, they can reduce them. But from current levels, they can't reduce them to try to help the economy. So they're kind of defenseless right now. There's a lot of pressure to get rates up. So I think they're going to go in June. And I think, yes, I think this, the employment report is going to be a soft report. But when you take a look, as you mentioned, the Beige Book, which suggested that there's a little bit of tightness showing up in the labor markets and upward pressure on wages, I think that gives them plenty of defense for raising rates, especially when the economy seems to be doing better, as the ISM report seemed to suggest. Auto sales were a little disappointing, but they're still pretty strong. No, I think we go in June, and I think there's a lot of pressure on the Fed, a lot of good reason for them to raise rates in June.
Okay, so here's the thing, right? You're in the June camp. We've got Fed funds futures dialing back expectations of June. It had been 1 in 3. Now we're about 1 in 4. And when you take a look at the shape of the yield curve, you've got the short end, the 2s at about 0.9. You've got 183, 184 on the 10. Have markets fully priced in a June hike?
No, not quite yet. The short end maybe to some extent has priced it in, but really rates are still a little bit low. If we go from 37.5 basis points on the Fed funds rate to 62.5, you're going to get higher rates both at the short end and the long end. Now, I'm being more specific. On a 10-year Treasury, for example, we're about 185. I see that up at about 2%, a little bit less maybe than 2%. If the Fed goes to 62.5. Statistically, I'm giving you numbers that I think make a whole lot of sense. So I don't think we fully discount it either at the short end or the longer end.
All right, Hugh, so this is the macro picture. I want to drill down now and get some sort of practical money advice. I want to play you this soundbite first, have you listen to it, and then get your comments.
Stock in the S&P 500 that has averaged a gain of even more than 5%. Is Facebook, and it's only been around for 4 years. The next stock, interestingly, is Amazon, which is up 53% since its February low, average gain of about 3.9%, one down year. And the third one was just in the news yesterday, Allergan.
So there you go. You've got Facebook, Amazon, Allergan. How do those names sound for you in the June month, which is usually pretty sleepy, Hugh?
Yeah, they're really good companies, and they're knocking the cover off the ball. The numbers we're getting on the revenue and on the earnings side of the equation on all three, really, but mostly Amazon, have been very, very impressive. So you're going to get really good numbers on an ongoing basis from those companies. They're kind of in a class by themselves. But there's a lot more companies out there that you need to look at to have a well-diversified portfolio. But there's no question they belong in a portfolio, but you have to have a strong stomach, because we're talking about, you're looking for big numbers, you're looking for, valuations that are not that great, a little bit high, and you're looking for lots of volatility in the stock price. So hang on if you buy them.